At 2:47 a.m. Beijing time, while most of the city slept beneath a veil of haze and silence, a single directive pulsed into the inboxes of China's largest exporters. The message was stark, unadorned, and absolute. Effective immediately, cease all US dollar transactions. No press conference, no preamble, no warning. Just 4 words, surgically deployed, that detonated across the global financial system without a sound. By the time the city's neon skyline flickered into dawn, bond markets were shuddering. In Tokyo, screens turned red. In Frankfurt, traders paused mid-sip of their coffee, eyes wide. In New York, phones lit up before the opening bell. The financial axis had shifted in the dark. No tweet, no televised ultimatum, just a silent act of monetary warfare. And the tremor was felt everywhere. The question hit instantly, is this the moment the dollar begins to die? Not with a bang, not with a battlefield, but through a single unspoken move that rewrote the rules of power. Behind that quiet order was a plan long in the making. In April 2025, the Chinese Ministry of Commerce had circulated the directive to more than 400 firms, state-owned giants, tech conglomerates, logistics titans. It was labeled non-negotiable. It didn't just suspend settlements in US dollars, it severed them. No further trade agreements were to be conducted in the currency that had ruled global commerce since World War II. According to a leak verified by the South China Morning Post, this wasn't policy adjustment. This was a strategic rupture. Within 72 hours, dollar-denominated trade settlement volume from China fell by 12.4%, according to Bloomberg. ING analysts didn't mince words. This is institutional de-dollarization. But beneath the economic language was a deeper current. Not just a rejection of US monetary dominance, but an attempt to replace it with something engineered, intentional, and entirely Chinese. Because the yuan wasn't just rising, it was being constructed, brick by digital brick. Between mid-2023 and March 2025, the yuan's share in global trade finance surged from 4.5% to 7.6%. That wasn't market drift. It was strategy. That wasn't evolution. It was acceleration. The yuan wasn't simply a national currency anymore. It was becoming the spine of an alternative global system. With digital yuan pilots expanding into bilateral energy deals, China's intentions were no longer hidden. They weren't retreating from the dollar. They were coming for it. And the backlash? Instantaneous. Within 2 days of the directive, US Treasury yields jolted upward. The 10-year note, long the global benchmark for stability, spiked 38 basis points to 5.09%. A level not seen since before the 2008 crisis. JP Morgan traced over $212 billion in Treasury sell-offs in just 4 trading days, much of it linked to sovereign funds and Asian institutional accounts. This wasn't some speculative shiver. It was coordinated. China's central bank had already trimmed its US debt holdings from $859 billion in January to $729 billion by March. But this wasn't trimming anymore. This was carving. Mohamed El-Arian warned on CNBC this shift could reset the world's borrowing baseline. Meanwhile, US bond market volatility erupted to levels unseen since the worst days of the pandemic. These weren't anomalies. They were aftershocks, the kind you feel after a tectonic break. The message was clear. If the dollar can be used as a weapon, Beijing will treat it like one. And what does a nation do with weapons aimed at them? They disarm them, or they replace them. The idea of dollar supremacy had been bleeding slowly for years, quietly, without panic. IMF figures showed the share of USD in global central bank reserves had slipped from 71% in 2000 to 57.2% by Q1 2025. But this was the drop that broke the rhythm. Not a leak, a rupture. Not a shift, a declaration. And China wasn't alone. As Eswar Prasad told the Wall Street Journal, what's happening is a deliberate decoupling. Not just among BRICS, but quietly, increasingly, even among some of Washington's traditional allies. In March, the yuan's share of cross-border transactions inside China climbed to 48%, surpassing the dollar for the first time in history. The numbers told the story, but the real moment came on April 18th. Saudi Aramco, the oil kingpin of the Middle East, confirmed its first full crude shipment to India. Settled not in dollars, but in yuan. Reuters broke the news. The implications broke the silence. This wasn't symbolic. It was foundational. The dollar didn't collapse with a single event. It began vanishing, one transaction at a time. And so the question shifted. Not what just happened, but what replaces it. What fills the void when the dollar recedes? What emerges when the old bloodstream dries up? SWIFT, the backbone of global money flows, still moves over $5 trillion a day. But it's built on legacy architecture, analog in a digital world. China had already begun constructing the replacement, mBridge. Co-developed with the UAE, Thailand, and the BS Innovation Hub. It completed a successful pilot in March, settling $23 million in cross-border trades in near real time. No dollar intermediary, no U.S. visibility, fully traceable, fully sovereign. Anna Naran of HSBC Asia told Bloomberg what many already knew, but couldn't admit publicly. This isn't experimental. This is operational. Real-time sovereign currency exchange, outside of Washington's reach, is no longer theoretical. It's here. While Washington continues to debate digital currency frameworks, China's digital yuan has left the gate. It's live. It's fast. It's growing. According to the People's Bank of China, it's already processing over $250 billion annually in domestic and cross-border payments as of April 2025. This isn't some sleek white paper. It's an entirely new circulatory system for money, and it's already flowing. Faster than SWIFT, harder to monitor, immune to sanctions. And in that silence, in that precision, lies its most powerful feature. As this new system takes shape, America begins to feel the aftershock from within. Markets twitch, policy scrambles. The dollar, long untouchable, now feels vulnerable. And as Trump moves to respond, the reaction begins to echo in monetary markets. Interest rates, capital flows. Not in isolation, but in echo. This wasn't just a monetary rebellion. It was a reordering. A new game has begun. Beijing played its first move without saying a word. The board has shifted, and the world is watching to see what checkmate might look like. On April 19th, President Trump posted just 9 words on Truth Social. Cut rates now, or we risk total collapse. Within hours, markets shook. Fed watchers held their breath, and whispers turned to shouts. The pressure was unmistakable. But slashing rates under duress isn't a rescue, it's a release valve. And what followed was a flood. The dollar index plummeted from 104.3 to 98.7 in just 5 days, the steepest drop since the 2009 financial crisis. According to Goldman Sachs, $76 billion in capital fled U.S. markets in that single week, a stampede led by sovereign sell-offs and desperate corporate hedging. The immediate fallout? A weaker dollar may jumpstart lending, but it also shreds trust in America's long-term financial compass. And trust is unraveling. Mohammed El-Arian warned in the Financial Times that pushing down the dollar artificially won't bring relief. It will trigger an exodus. Gold, commodities, even crypto, they're absorbing the shock. And for the first time in 4 decades, the dollar is losing ground simultaneously against the yuan, the yen, and the ruble. That's not coincidence. It's realignment. Because while Washington floods the system, Beijing is rewiring it. So who's actually in control? Look beyond the headlines. According to Q1 2025 data from the Lowy Institute and IMF, 128 countries now trade more with China than with the US. Not just adversaries, Germany, South Korea, the UAE, even allies like Australia and Chile. China's exports surged 8.9% year over year. US exports? Down 3.2% according to the Census Bureau. And Bloomberg makes it clear, this isn't just volume, it's velocity. China is locking in bilateral deals across Asia, Latin America, and Africa, while the US hasn't signed a major new trade pact since 2020. The global trade map is tilting east, not just economically, but strategically. Trade now follows power, and power increasingly doesn't speak English. But this shift isn't just about containers and cargo. It's about capital. The U.S. economy shrank 0.7% in Q1 2025, marking the second straight quarter of contraction. A technical recession, yes, but under the surface, it's worse. Real wages are down 2.1% from last year. Credit card defaults hit 3.6%, the highest since the post-2008 aftermath. Small business bankruptcies surged 18% in April alone. Mortgage delinquencies spiked 12% month over month. Freddie Mac's April risk memo warns of systemic stress. And Morgan Stanley now sees a 40% chance of technical depression before year-end. The Fed is stuck. Raise rates and housing cracks, cut them, and the dollar bleeds out. These aren't policy levers anymore. They're weapons, with no safety switch. The damage is mounting. The ISM Manufacturing Index just fell to 44.7, lowest since the pandemic's early chaos. Export orders dropped 9.3% quarter over quarter. Import volumes at key West Coast ports collapsed 27% year over year. The Port of Los Angeles confirms the slowdown. U.S. exporters are suffocating. Nearly 20% of major manufacturers have lost access to essential Chinese suppliers, thanks to Beijing's capital payment ban. Boeing, once America's pride in exports, lost $14.2 billion in orders in Q1 alone, double the hit it took in Q4 2024, according to Reuters. Trade credit insurers like Euler Hermes are now slashing U.S. exposure limits, citing growing non-payment risks and volatility. If global trade is the bloodstream, America is starting to clot. But what if the wound is self-inflicted? Because beyond the Fed, beyond trade, there's something deeper unraveling. Fiscal credibility. In just the first 4 months of 2025, the U.S. racked up a $1.3 trillion deficit, fueled by spiraling entitlements and emergency market interventions, per the Congressional Budget Office. And trust in U.S. Treasuries is fading. Foreign central banks now hold just 38.6% of total issuance, down from 44.9% in 2019. It's not just China stepping back. Japan trimmed holdings by 11%, Belgium by 14%, even Saudi Arabia cut to a 9-year low. That's not drift, it's retreat. As El Arian told Bloomberg Surveillance, confidence doesn't vanish overnight. It erodes, slowly, painfully, through erratic fiscal policy and weaponized economics. The U.S. didn't lose the world's faith. It pushed it away. So ask the real question. Is the dollar under attack, or is it being abandoned? Because while China methodically detaches from the dollar, the U.S. seems determined to unravel it from within. This isn't just a monetary crisis or a trade shakeup. It's the slow-motion detonation of the dollar's global supremacy. The UN is gaining ground. U.S. treasuries are losing prestige. And the policies coming out of Washington are accelerating global disinvestment. The next domino might not be a trade deal. It might be a reserve rotation, a global pivot away from the dollar as the world's financial bedrock. If that moment arrives, it won't just be Wall Street that trembles. It'll be pension funds, public salaries, grocery prices, and rent payments in every American home. This isn't theory. It's already in motion. And here's the part nobody's saying out loud. What if this isn't the crash? What if it's the setup? What if the world isn't just reacting to dollar decline, but preparing for what comes next? Because whether you see it or not, a post-dollar world is no longer impossible. It's being engineered. So ask yourself, is this the end of American financial dominance or just the obituary Washington is writing for itself?